Did an automated news bot just hallucinate an earnings miss and instantly tank a stock? Because the numbers today say yes. Welcome to Earnings Unscripted. It is June 15th, 2026, and today we are looking at PowerFleet, ticker AIOT. They just released their fourth quarter 2026 results, and the market reaction is just wild.
Wild is one word for it. It is actually a complete data failure. The financial aggregates pulled PowerFleet's GAAP net loss, which was negative 2 cents a share, and then they blindly compared it to a non-GAAP consensus estimate.
Which is apples to bowling balls, basically. Actually, quick pause. Speaking of legal realities, just a reminder, this podcast is purely our personal opinions, definitely not financial advice. But Mira, the actual adjusted EPS was positive, right?
Positive 4 cents a share. Yeah, they doubled. Adjusted net income doubled to $5.6 million. The per share number was 4 cents. So the reality is completely divorced from the headline. The stock was looking strong pre-market around $4.48. Then the bell rings, the bad data hits the wire, and it just plummets to an intraday low near $3.80. It eventually stabilized, but still closed down about 4.5%.
Which has to be so infuriating for management, especially because if you look at the actual business, they are pulling off something really difficult. PowerFleet basically provides AI hardware and software for logistics fleets. And this quarter, they intentionally let their hardware product revenue slide down a bit to $21.5 million.
Well, that is the whole strategy, though. Hardware is just a Trojan horse for them now. You take a hit on the physical product to lock in the subscription.
Right. It's the razor and blade model.
And we see that working. Services revenue ticked up to almost $93 million. That's 81% of their total top line now. Total revenue was basically flat sequentially at $114.5 million, but the mix is just way healthier. Operating income jumped over 70% quarter over quarter to $11 million.
That makes sense. Software margins are just infinitely better than selling physical sensors.
Exactly. Adjusted EBITDA at $26.4 million. That's a 23.1% margin. They're clearly getting operating leverage from moving to software.
Okay, to put a real-world face on this, I loved the anecdote the CEO gave on the call about FEMSA. They're this massive Coca-Cola franchise bottler. FEMSA originally just brought PowerFleet in to put AI dash cams in their delivery trucks, mostly just to track road safety. But the software gave the executives so much data, they ended up adopting it inside the actual warehouses too, literally tracking the forklifts on this exact same software platform.
That cross-sell is huge. Most competitors do either on-road fleets or warehouse logistics. Very few actually bridge both. And PowerFleet's on-site warehouse revenue jumped 39% this year because of that exact dynamic. But, landing those mega deals requires fronting a massive amount of capital.
Okay, yeah. Let's actually get into the details on how that impacts their cash flow, because the guidance there is definitely telling a story.
It is actually the classic trap of winning a mega deal. They had just landed this massive 5-year contract with the South African National Treasury, upgrading, I think, something like 60,000 public sector vehicles over the next few years.
Which sounds incredible until you actually have to pay to manufacture and ship 60,000 pieces of physical hardware.
Right, exactly. Installing those sensors burns immense cash before you can bill for a single monthly subscription, and that dynamic is completely warping their forward guidance. They expect 30 to 35 million in free cash flow for fiscal 2027. But management pointed out that roughly 90% of that is backloaded into the second half of the year.
90%? Okay, so the first 2 quarters are essentially a cash flow desert?
Pretty much. They have about 12 million in upfront optimization expenses hitting right now, plus all the physical deployment costs for South Africa. David Wilson, the CFO, was very direct about it on the call. He warned that first quarter adjusted EBITDA margins margins are expected to be about 1 percentage point lower than what we just saw in Q4.
Going backward on margins, even temporarily, is a really tough pill for the market to swallow, especially when investors just watch them hit 23% and probably want a perfectly straight line up from there.
And the market never gets a straight line, but this is where I think management is being fairly clever behind the scenes. They realize they cannot keep eating this initial hardware cost if they actually want to generate reliable cash flow.
So what do they do then? Do they just hike the software prices?
No, they are changing the terms of trade. They are aggressively pushing new enterprise customers to pay either the first quarter in advance or an entire year in advance. It's basically demanding that the client or a third-party financing partner finances the hardware rather than PowerFleet bloating their own balance sheet.
Oh, I love that. That is a massive flex of pricing power. You know you have a sticky product when you can look at a global enterprise and say, sure, we'll digitize your fleet, but you're floating the capital for the hardware.
It is a power move, absolutely. But you need incredible distribution to actually pull that off, which brings us to the other catalyst buried in this report.
The Accenture partnership?
Yes, this completely changes their go-to-market structure. Accenture selected PowerFleet as a strategic safety innovation partner. So when Accenture goes into a Fortune 500 company to overhaul their logistics, they are embedding PowerFleet's Unity software directly into that consulting deal.
Rather than PowerFleet trying to knock on those enterprise doors themselves.
Exactly. Steve Towe gave this great example about the Pepsi pipeline. He pointed out that these massive warehouses have historically managed millions of dollars in physical assets using spreadsheets and pens, just literal clipboards.
Spreadsheets and pens, the absolute enemy of efficiency.
Totally. Because building an AI system to pull clean safety data from a random mix of forklifts and delivery trucks, it is incredibly hard. Accenture looked at that and decided it is just cheaper and safer to use PowerFleet's proprietary data rather than trying to build algorithms from scratch.
So PowerFleet stops being just a point solution vendor and becomes more of a fundamental API for these global consulting giants. That is a huge multiplier.
It is. It offloads a ton of selling expenses down the road. But it circles right back to that early cash flow warning. They have these huge top-of-funnel opportunities, but securing the network costs real money today.
Right. So the core tension here is patience. Can investors sit on their hands through a heavy spending quarter while the foundation gets poured for the back half of the year? Because to me, that sets up a really fascinating dynamic for the outlook.
Well, patience is exactly what they are asking for, because the full-year target is pretty aggressive. They guided revenue around $485 to $490 million, so roughly 10% growth. And the adjusted EBITDA is supposed to jump up into the $122 to $125 million range.
Which implies an EBITDA margin of what, 25%? That is a huge step up from where we are right now.
Right. And David Wilson, the CFO, practically pleaded with investors about that exact expectation. He explicitly stated the year will not move in a perfectly straight line quarter to quarter, which is his justification for why they only give annual guidance instead of quarterly. He's basically pre-apologizing for the bumpy start.
So the entire thesis really hinges on them executing flawlessly in the back half. Because if that massive South African rollout hits a snag, suddenly that backloaded cash flow just never arrives.
And that is the absolute key risk to watch next quarter. There was a recent Wall Street Journal piece claiming international companies were fleeing South Africa due to geopolitical instability. Management completely dismissed it on the call. Wilson called those fears, quote-unquote, overblown. But look, when 25% of your total revenue is tied to that one specific region, any friction is going to make the market very nervous.
So, stepping back, I guess the overall takeaway is to ignore the weird algorithmic stock hallucination from this morning, but keep a really close eye on how they actually deployed those hardware units this summer. Because if they pull this off, turning heavy logistics hardware into a sticky software subscription, it really is a fascinating business story.
It is a solid strategy. I have to give them credit for the structural vision. The transition looks completely beautiful on a spreadsheet. Now we just wait and see if the physical world actually cooperates.
Spoken like a true numbers guy. We'll definitely be checking back on their progress next quarter. That is going to do it for us today. Thanks so much for listening, everyone.
See you next time.
Quick thing before we actually go, if you want these earnings drops to just automatically show up in your feed, feel free to follow the podcast wherever you are listening right now. And for total transparency, our voices and the actual research synthesis for the show are generated using AI, pulling the raw facts right from the company filings. If there's a specific ticker you want us to tackle next, drop us an email at earningsunscripted@datamadness.ca or check out the X link in our show notes.
We read every request. Thanks for listening.